Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There is just an hour to go now until the closing bell, and the stocks are falling here, with the big stories in markets today being the sell-off in chip stocks and the continued rise in oil prices. For that, I have Yahoo Finance's Jake Conley with me. Jake, let's start on chips, because that is a big story in today's trade. The story with chips was a really good story, and it was basically, these chip CEOs and CFOs, they would come out and they would tell you, business is strong. Business is great. In fact, it's so great, we can't even keep up with demand. We can't keep up with demand.
We're booked years out.
Years out, and so investors thought, well, that sounds pretty good. That sounds like good times from here to eternity. So then, I guess, what do we make of this sell-off? Do we think, okay, this is really, it's just mechanical. It's profit-taking after parabolic moves, freak show moves? Or do we think, no, there's something more fundamental, more structural going on here? Something has shifted.
Part of this is certainly the profit-taking narrative, right? We saw these stocks just run up. We saw the Philly Semiconductor Index absolutely soaring. We saw stocks like Micron up 200%, 300%. At some point, people have to take profit, right? Investors have to say, I can't call at the top here, so I've got to take some money out of the trade. We saw a lot of that over the last couple of weeks. That's leading into this kind of, if you want to call it a rotation right now. At the same time, we also get the worries around those spending targets. It is absolutely bullish on its face to be saying, we're going to boost our CapEx, we're going to spend even more, we're going to push this farther, our order backlogs are even further out. At the same time, you have to ask, how long can that run on? How sustainable is it? On the Mag 7 side of this, taking the other side, we've seen the debt issuance really become a question. On the chip side, the question is now, okay, you're spending a lot, where's the ROI? How fast is this going to move? And at some point, if the Mag 7 spending slows down, what does that do to the actual chip trade? Now, that said, Bank of America out today, analysts led by Vivek Arya, saying that even though we saw semiconductors pull back over the last, call it 2 weeks or so, they're set up for a strong finish throughout the rest of the year. They give a few reasons for that. Commitments and order backlogs, as we talked about, remaining strong, remaining hot. AI is seen as improving its ROI, actually starting to see some money come back in the door as the models get better, as the technology gets more efficient. Also, on the financing side, most of the analysts on Wall Street who look at this are predicting free cash flow to start coming back, especially in 2028. Once the ROI is there, we're going to see some of that money that's going out the door right now actually start to come back in. Even when you look at the Chinese open source models that have really been threats to the likes of Anthropic and OpenAI, we saw the Kimi 3 news overnight, sparking a bit of a worry there. Bank of America makes the point that yes, those might disrupt the market for the American frontier labs, but for the semiconductor industry, it's just more business. It's more sign of how popular this trade still is.
You mentioned the Mag 7. What happened? Their earnings are on deck. Let's say they come out and they say, you know what, CapEx, it's moving higher this year, it's moving higher next year. Then what would you expect money, flow back into the chips?
I think a few months ago I would have said yes, but right now we're in a weird position. As we keep talking about, the market is somewhat priced to perfection, but that goes both ways. If these companies come out and say, we're boosting our CapEx, we're going to spend 1.5x what we said we were going to spend, that is certainly bullish. Does it also raise the question of, are you overspending, right? We saw this conversation with Meta when they announced they're going to start selling compute. The question was, well, did you overspend? Did you overbuild? And then you've got to try to recoup some of that cost. At the same time, though, if they slow down that CapEx even a little bit, the market's going to immediately read that as bearish, immediately pull back on those names. You'd probably see some panic movement. So right now you have to ask yourselves, if I'm Mark Zuckerberg, what side of that do I want to be on, and how do I balance what's going to get lauded by Wall Street and Main Street and what's going to spark fear on either side of the ball?
Let's switch gears, talk about another subject you know very well. These escalating tensions with Iran, right? What's the latest?
6th straight day now of conflict in the Strait of Hormuz. The worrying developments today were twofold. The first of those is that attacks by both the US and Iran have been escalating past military infrastructure to actual civilian infrastructure. On the US side, we saw the US strike several bridges, critical road bridges inside Iran. We also saw them strike Bushehr in the south of Iran, which is the city that houses the country's only nuclear power plant. This is not the centrifuges that are enriching uranium, but the only nuclear power plant that's providing electricity to people in the country. We saw that city get struck, raising concerns there about how that could affect the area, the electricity, whether President Trump will go forward with his threats to actually begin striking power plants and electricity infrastructure. On the Iranian side, not only did they continue to strike U.S. installations inside Kuwait, inside Bahrain, inside Jordan, but we saw news that a desalination plant, a water desalination plant in Kuwait had been struck. Now, the problem here is that the vast majority of the Middle East really relies on water desalination. These are desert, arid countries. They have to have clean drinking water. Those desalination plants are what provide that. If we were to see those get targeted, the worry is that that could spark a massive humanitarian crisis. The second problem we saw pop up today is further west in the Red Sea. The worry with the Red Sea was always that the Houthis, this terrorist proxy force in Yemen, could close off what we call the Bab el-Mandeb Strait that goes from the Red Sea down into the Gulf of Aden and then out into the market. Saudi Arabia has managed to move around 5 million barrels per day of oil through a pipeline that runs from the east of the country in the Persian Gulf to the west to the Red Sea, load that onto tankers and bring that down through the Bab el-Mandeb. The worry is that if the Houthis cut that off, the market loses its most important release valve right now. Now, it's not confirmed what actually happened. There was a report from a maritime trade organization saying that a vessel was forcibly boarded. The details are very unclear, but it did start to spark these worries again.
What do you think happens next in the Strait and to traffic in the Strait? Because I'm just curious what you think shippers are feeling right now. Like, do they think, it's worth it, or do they think it's not worth it, even if I have this U.S. escort?
This is moving day by day. Traffic has not stopped. We have seen it significantly slow down in the last week, but it has not stopped. However, you are seeing signs of fear. We saw India telling some of its shippers, do not move, do not attempt the crossing. We think it's too dangerous. We've seen some ships try to make the run for it, and we've seen several ships get attacked in the Strait by Iran, immediately raising that threat profile again. Nobody I talk to thinks we're going to see traffic drop to zero unless the picture rapidly deteriorates even farther. But at the same time, this is a very complicated risk calculation for shippers, for ship owners, for companies. We're kind of back to where we were in the beginning stages of the war. You are likely to see some smaller companies, higher risk tolerances, maybe some smaller Greek shipping companies try to make that run. But the big players here, they're going to be concerned about insurance. They're going to be concerned about safety. They're going to be concerned about what happens to their vessels, that not only are they carrying millions of dollars worth of cargo, but those are millions of dollars worth of vessels and equipment. That traffic will almost certainly be slower to come back. And if we see this get worse, could deteriorate even further, constricting the oil market even further.
Jay, great stuff as always. Thank you, buddy. Appreciate
Thanks, Josh.
it. Well, IBM kicked off the week with a stark warning for the software sector, saying that customers are shifting their spending to AI instead of traditional products. This comes as we're set to get earnings from big names in the software space in the coming weeks. So how much of a risk is AI for SaaS companies? Joining me now is Rishi Jaluria, RBC Capital Markets Managing Director of Software. Rishi, my friend, always great to see you. Maybe start off big picture for us, Rishi. AI disruption fears, we know, of course, have been front and center for the software sector. As a guy who sort of just lives and breathes this, Rishi, I'm just curious what you think what are some of the big misconceptions you think investors might have about that trend, about that dynamic, Rishi?
Yeah, absolutely, Justin. Always a pleasure to be here. Thanks so much for having me. Look, I think there's two big misconceptions out there. Number one is thinking about AI versus software and thinking about them independently is actually increasingly intertwined. Like, at the end of the day, what are Claude Code and OpenAI Codex and Cursor? They're software, right? It's just a very new form of software, and it's agents and multi-agentic systems. And importantly, as we're talking to CIOs, as we're talking to industry participants, that intertwining of software and AI is very much clear. The second is there's this thought process that AI is going to replace software, that enterprises that are using the likes of Salesforce and Workday and even Microsoft products will just use Claude Code or OpenAI Codex and build their own versions of that. And you're going to see some headlines around that. You saw some headlines last week from Starbucks saying they're going to use AI to replace some systems from IBM and Microsoft. But at the end of the day, if we do the math on this, these companies are going to spend use their best and brightest AI talent. They're going to actually end up spending more money, especially when you think about this on a TCO perspective, for worse products. And I think as that realization sets in, we could see at least less dire, sentiment on a lot of these software names, especially in the application arena.
You say your investors, Rishi, should watch for business model disruption for software names. Companies moving, you say, from seat-based pricing to consumption-based and outcome-based pricing. What does that mean exactly, Rishi? Can you break that down for us simply? And also, Rishi, how long you think that transition you're talking about could take?
Yeah, absolutely. And this was a big theme coming out. We just held our flagship software and AI bus tour in the San Francisco Bay Area last week. This is a big theme coming out of that. So at a high level, software has been priced on this per user, per year model forever, right? And it's very predictable. It scales as companies are hiring. Now in this new world, there's two things that are happening. Number one is you're seeing hiring slow down. And in fact, you see tech layoffs this year almost larger than all of last year. So there's pressure on just seat growth and headcount growth. And so that's number one piece that's happening. Number two is by using AI with these software systems, there's a lot more output and a lot more efficiency that can happen with the same users. And companies need to figure out ways in order to monetize that without punishing their customers. And that's where you hear this idea of consumption, that the more you use AI embedded within these software products, where I think like a HubSpot with their Breeze AI, you pay for that. And then just to kind of align incentives, that's where you're hearing this conversation around outcome-based pricing starting to come to the forefront. This is stuff we've been writing about for 2 years now. But the idea is, instead of saying, hey, the more you use, whether there's real tangible results or not, the more you pay. Instead, how do you align it that if your customers get really good quality outcome from using your AI products, only then will they pay, right? And you can imagine things like, if I'm using AI agents in my call center, as a customer, I'm paying dollars per call deflected or dollars per IT ticket resolved if I'm using this on an ITSM system. That's what outcome-based pricing means. It's going to be a multi-year transition. I think we're all going to be kind of learning this as we go, but I think it's pretty clear that the end state will be some hybrid of this traditional per user per month or per user per year model and some level of outcome and consumption pricing. Your
CIO survey found, Rishi, 77% of contracts now require some level of negotiation. I thought that was really interesting. What do you make of that, Rishi? Does that suggest to us that software names, software companies are losing pricing power here?
I think that's right. I think in the near term, we're going to see companies that have relied on, 5 to 7% annual price increases year after year after year. It's going to be harder to get away with that because you have a lot of budget that's being allocated to AI. You have a lot of time and attention that's being allocated there. And if I were to think about companies that rely a lot on price increases, that rely a lot on just selling multiple products that may not be super mission critical, maybe more nice to have than need to have, I think some of those companies might be a little bit more in trouble. Whereas I think companies that have been arguably underpricing their products, historically, they're going to be in less trouble in this sort of environment.
Rishi, let's end here on some picks. You like Microsoft. Now, I was just talking on the show to tech investor Dan Niles, and we were talking Microsoft. Not a fan of Microsoft, not a fan. I asked him why, and Mr. Niles said, well, in part, it's because Satya Nadella does not have a leading large language model, and that is a big red flag to me. How is he wrong, Rishi?
Yeah, absolutely. Look, I respect Dan. He's a very thoughtful guy. What I'll say is I don't think a company needs to have their own frontier LLM to be a bit winner, right? I think there's a lot of value in how do I take multiple LLMs, not just OpenAI and Anthropic, but even a lot of these open source models that you see are starting to narrow the gap with the frontier models. How do I leverage that? And how do I bring my domain and workflow expertise and help enterprises realize true value out of AI, whether that's measured in efficiency and productivity, whether that's actually generating net new revenue, improving competitive win rates. And I think Microsoft, especially given the breadth of their software stack, starting with Microsoft Office, which is the most widely used business productivity suite in the entire world, to everything else, their security features, GitHub Copilot, security, everything, right? All of that. I think that they have the biggest opportunity out there to really help the largest enterprises in the world realize true value out of that AI. And don't get me wrong, that still benefits OpenAI and Anthropic, but I think Microsoft also becomes a big beneficiary as a result of that.
Finally, you like Rishi, NICE and Pegasystems. Explain those two picks for us. Why are those two compelling investments here?
Yeah, absolutely. And I would add a third that we named on our preview, which was HubSpot. These are names that we like a lot more long term. So not necessarily into earnings, just given the lack of visibility, but just quick 10 seconds on each. HubSpot, we think they're innovating a lot when it comes to AI, especially the sales and marketing stack. And we believe they'll be able to drive real monetization and improve win rates versus incumbents as a result. Pegasystems, we believe, as you think about the proliferation of AI agents in the enterprise that still need to work with traditional systems, not just SaaS, but on-premise and even mainframe systems, Pega's in a great position to be able to bring all of that together and connect that in a workflow or in a case. And finally, NICE, this is a name that's been heavily punished, but we do truly believe that call center is going to be one of the biggest areas of application for AI. And NICE is one of the leading contact center vendors, actually the largest out there. They will be in a great position to be able to help companies, again, apply AI throughout the entire environment, not just having AI voice agents deflect your call, but everything throughout the full call lifecycle. And we think NICE is in a great position for that.
Rishi, as always, so great to have you on the show. Thank you, sir.
Thank you.
Coming up, we're calling for tech support with Yahoo Finance tech editor Dan Howley. That's next on Market Domination. China's AI race is accelerating. Startup Moonshot saying its new model can compete with top offerings from OpenAI and Anthropic. Here to break down all the latest headlines, we're calling in for tech support with Yahoo Finance's Dan Howley. All right, Dan, so let's start there. China's Moonshots with an AI model, it says, narrows the gap here with American companies. Well, let's just start there. What is Moonshot, Dan? Explain that. And then how significant is this news in your opinion?
Yeah, Moonshot is a AI development company, AI developer, similar to what you would see from Anthropic, OpenAI, and it's open source or open weights rather. So that means that people are able to download the software and run it if they can for free, but a lot of people don't have massive server farms. So what Moonshot does is they will charge people to actually run the software on their servers, or in some instances there are open weight companies that will charge if you're going to use their application programming interface commercially. But so this is Kimi 3, K3 is what they also call it. And so it's consequential because of how powerful it is, or how near frontier it is. It's basically, they say it has frontier level capabilities, just shy of Anthropic's Fable 5 or OpenAI's GPT 5.6 Sol, and those are their top models right now that are available. Obviously, Anthropic also has Mythos 5, but that's in limited availability for basically cybersecurity kind of measures. And so the fact that this company is able to offer this shows that the Chinese AI companies are catching up with the frontier U.S. labs very quickly now. It also however, shows that people are increasingly using these models, these open weights models, because of how inexpensive they are to run. And so that's one of the big differentiators when it comes to these types of companies and the frontier companies that we regularly talk about, the OpenAIs, the Anthropics, the Googles, and what have you. They do have some open weights models, but their big frontier models are proprietary, and so you have to pay to access them. And so a lot of times the cost is a lot higher to be able to actually access those versus something like a K3.
I'm sure, Dan, one question investors might have as they listen to all this would be, okay, is all this historic American big tech AI CapEx, is that actually money well spent, Dan, if now we're seeing Chinese companies move in and create these strong models at much lower cost?
I think that's a question that they're absolutely going to have to answer. I don't think there is an answer just yet. This is kind of not exactly, but kind of the same discussion that we had with DeepSeek when that came out. I believe that was last year with their R1 model, how they were able to train it up using low power GPUs or lower powered GPUs than state of the art, and provide a model that was very robust. I think it's not exactly the same, but it's one and the same. I think, is the spending worth it? Do you actually need to be going all out with these kind of high costs moves, this big data center build out where you're using this to train and then serve models up? I mean, that still seems like it's going to be something that needs to be done. Running these models isn't exactly easy, so I think the data centers really are kind of maybe a little bit more insulated from this. But if it's easier to train and run these, then maybe they don't actually have to be as powerful as they currently are. But that aside, I do think that the Anthropics and the OpenAIs probably look at this and they say to themselves, well, geez, we're spending a lot of money to train up these models, to develop them, and then we have competition in China that is able to do it seemingly for less money than we are. That was also part of the discussion with DeepSeek. At the time it was OpenAI obviously being the main kind of company, and the kind of question was, well, are they investing properly? Are they doing this right? So I think we really have to wait and see what happens now on the flip side, where OpenAI and Anthropic or Google come from. We had that report the other day from Bloomberg, basically talking about how Google was delayed with its models. Google pushed back and said that they're happy where they're at and they're moving forward. So we still have that next model coming out. We'll still see something coming out from Anthropic and OpenAI. I think what we've kind of talked about generally is that these models are going to continue to kind of tick and tock back and forth, where one is in the lead, one is behind. The one that was behind steps into the lead again. And now I think it's going to be more opened up globally as we start to see China continue to push forward and closer into the frontier.
Well, that's what I wanted to ask you about, Dan. I mean, just more broadly, when you think about this great AI arms race, right, how quickly is that gap shrinking, Dan, between the U.S. and China?
It has been shrinking and it continues to shrink. We just saw Anthropic and OpenAI debut their latest models, the Fable 5 and GPT 5.6 Sol last month. And so, it's not as though it's been a long time since they came out with this. K3 is a big step up from Moonshot's last AI model. So I think that's an important context there. Obviously Anthropic and OpenAI have been leading in kind of the frontier space, and frontier just meaning it's, the top of the line. They've been leading in those spaces for quite a while. So, Moonshot hasn't, and now they're kind of right up there. And this is all based on, by the way, on their evaluations. So, I think third parties are going to dive in and confirm that or provide their own kind of guidance on what the capabilities of this particular model are. But we are seeing this happen. And, I think if you look at I think of NVIDIA's Jensen Huang. He regularly brings up open source models or open weight models during presentations, and he always features the Kimi models as well as the Quen models. The open source kind of area. NVIDIA has its own open source models as well, and those are always relatively close to the competing models from the West. And so, at this point, it does feel as though that gap is shrinking.
On this same AI theme, Dan, Chris Mims at the Journal out with a new column, how AI's wider availability is good for China, not great for OpenAI and Anthropic. Mims asking, if AI models turn out to be a general purpose technology like the automobile or electricity, what can they uniquely offer? How do you answer that, Dan?
I think it's going to come down to likely platform and ecosystem. One of the things that a lot of these companies can do, these open source or open weight companies, is offer surrounding services. So that's, you have a piece of open source software, the company that puts it out is then able to provide a wrapper around it, or, customer support, things along those lines. And that could be something that OpenAI and Anthropic and their like lean further into. And we've seen them, kind of do that. Sure, we talk about their latest models, but, and they power their software, but their software on its own is really, I think, what's been driving their kind of popularity. If you look at Claude Code, for instance, yes, that does run on Anthropic's Claude software, and yes, that is a key element to it. But they also, my point is that there's these different pieces of software that they could market that are run on their models that could be a kind of hedge against this kind of commodification of these model capabilities. And so, I do think that they have other ways around this. And again, this is still pretty early for us to, just kind of throw our hands up and say, well, everyone is equal now. I don't think it's quite there yet. I think, there's still also a lot of way to go in terms of AI's overall abilities when it comes to these models. And so, yes, K3 is very capable, but I do think that, obviously Anthropic and OpenAI are still in the lead, and we'll see more advancements from them, as well as, Moonshot, Google, Meta, by the way, they're working on their Muse line of models. So there's still, I think, a good amount of room for this competition to continue.
So is your point, Dan, is this why you would see a Sam Altman moving into agents and software and hardware because he's building out this entire platform, this ecosystem?
Yeah, exactly. I mean, that's why, I mean, obviously AI agents came along, we were talking about them in 2025. That was supposed to be, when they really blew up. And then obviously this year and early this year is kind of, I think, when it's really hit the kind of broader zeitgeist. But one of the things that they are doing, as you point out, is rolling out these new pieces of software. So they had Codex that allows you to do different types of programming work. Then they also have their own GBT work. Now that's a piece of software where you would do things like work through spreadsheets or put together slideshows, kind of the things that everybody on the planet despises having to do but does anyway. That's supposed to help you along those lines. Anthropic has the same thing. They have Claude Cowork. So, you're seeing more of these companies lean into how they can serve up the models in different ways that really provide, a boost to not just them, but, obviously the user. And so the more people want to use that, the more seats they can sign up when it comes to different companies. And so that'll help them kind of grow their revenue over time. And so, as I said, the models are incredibly important to all of this, but it's the software that they kind of run under that is just as important.
Finally, Dan, got to get your take on this one. This one's wild. Leather jacket, Dan, worn by NVIDIA CEO Jensen Huang on auction at Sotheby's. Dan, it looks like the final bid was $960,000. Now, Jensen, there it is. Hey, listen, that's a handsome jacket. No one's doubting that. Jensen is a historic business figure. He's on the Mount Rushmore. I don't think anybody disputes that. But what do you make of this, Dan? What does it say about the moment we're in that someone was willing, Dan, to pony up nearly $1 million for Jensen's jacket?
I mean, kudos to Jensen for someone really liking him that much, I guess. That person probably has a lot of money and maybe too much if they're spending almost $1 million on a leather jacket because it was worn by someone. But I do think that it just shows, kind of how important NVIDIA and CEO and co-founder Jensen Huang are to the kind of AI race as it exists today. This is a company that was making these investments years and years and years before they would pay off, and they really have in spectacular fashion. Obviously, NVIDIA is just essentially synonymous with AI now, when it was previously synonymous with gaming. And so I think it does really. I mean, you can see him when he goes to different events, right? He's almost like a rock star presence. People are always rushing him for autographs. I'll go to press events that he's at, and members of the international press will just swarm around him, trying to get photos, or influencers trying to get photos with him. And he, more than happy, obviously, to take those pictures and kind of bask in that kind of adoration. But the jacket is wild. I mean, first of all, he had a cooler jacket, I think, at CES a few years ago. It was all shiny and stuff. I think that was just cooler for my personal opinion. But man, $1 million, that's, I mean, I'm talking like, Ken Griffey rookie card. Like, that's what I'm thinking is, I mean, I don't know how much that's worth, but that's what I would, spend it on, or like a, unopened copy of Pokemon maybe from, the 90s. That I could see myself spending $1 million on, but a jacket, not really for me.
Dan Howley, thank you, buddy. Appreciate it. Coming up, SpaceX shares taking a hit after aborting its Starship launch yesterday. We speak to an analyst about that stock. That's next on Market Domination. William Blair is getting more bullish on SpaceX, raising its estimates for the company's rocket launch business and seeing more than 40% upside in the shares. But those shares taking a hit as of late. Let's look at Yahoo Finance's Alpha Space right now. We'll just pull up a stock chart, and you can see it's not pretty. And we have actually moved below, importantly, that IPO price. Now, the reasons for that, different questions. Is that what you're looking at there just normal post-IPO volatility? Are there new questions about execution risk or valuation risk? Lots of questions about this one. And we have, thankfully, just the man here to help break down the latest moves. That would be Louis DePalma. He's research analyst at Industrials at William Blair. Louis, it is good to see you. Maybe actually I want to start, Louis, with the news today, or the news from yesterday, that delay of the Starship launch, Louis. I'm just curious, what happened there? What do we know, and what do you make of it, Louis?
Yes, happy Friday. In terms of the Starship delay that was scheduled for yesterday, when these rocket launches happen throughout the satellite industry, delays are pretty common, whether they're weather-related or whether there is a technical issue. The Starship is so sophisticated. We've written about how it's a full decade ahead of peers. They're on the frontier of new technology, and they want to make sure that everything is precise. So there were certain boxes that weren't checked, and that there's redundancy and triple redundancy for all of the processes that go on with these rockets. And they always have tomorrow or the next day or the next week, and that this is a multi-year or even a decade-long timeline in order to perfect the full reusability of Starship.
Louis, we're showing the stock price there, and obviously it moved below the IPO price. I'm curious, Louis, to get your thoughts on what you think is going on there. What explains that? Do you chalk that up, Louis? Is that normal post-IPO volatility? Or no, Louis, is it execution concerns? Is it valuation questions? What is going on?
Yeah, great questions. For starters, in terms of the broader context, if you were to rewind the clock a year ago, SpaceX was valued at approximately $500 billion. And when SpaceX IPO'd last month, they IPO'd at approximately $1.8 trillion. So the equity value of the company is still substantially higher than it was. However, it's down modestly from the IPO price. There was a significant run-up in space and defense tech stocks over the past year, but in particular, many different space-related companies appreciated in value related to the SpaceX halo effect. And there has been a derating type correction over the past few weeks as valuations have come in a bit.
Do you think, Louis, though, I'm curious, if I'm in this name, what are the catalysts near to intermediate term that I should have on my radar that could move this one higher? Is it the successful Starship launches? Is it faster Starlink subscriber growth? What am I watching for, Louis?
Great. Yeah, and our formula for SpaceX is Starlink plus Starship equals Starbucks. And Starlink is the moneymaker for SpaceX. And their satellite broadband business is gaining 1 million subscribers every quarter. I think they'll end the second quarter with 12 million. And the catalyst here is associated with Starship, in that currently Starlink broadband already achieves fiber-like speeds, and they're taking shares from the incumbent telecom providers, but it's going to improve by an order of magnitude. So that's one of the main catalysts. The second main catalyst for the near term is renting data center capacity to hyperscaler customers. They recently announced the deal with Anthropic for $11 billion. And the Anthropic deal was $15 billion. The Google deal was $11 billion. And they're in talks to rent capacity to the U.S. Department of War. And those deals are huge in terms of profitability and also just the size relative to the existing business.
Louis, what could break your bullish thesis? Like if we're talking a year from now, Louis, right, and the stock's, meaningfully lower, what do you think would be the most likely, reason or reasons for that?
Yeah, another great question. One of the key risks here and one of the potential causes of the recent volatility is the fact that the AI market is so volatile. You were talking about all the AI puts and takes with open source competition from China on the prior segment. But 2 weeks ago, there was an article about how Meta might be selling excess data center capacity. And that struck a nerve for some SpaceX investors because the market has been capacity constrained. So there were talks such that, is there now oversupply? Is it a better business to sell data center capacity rather than to develop models such as Grok or Gemini, OpenAI, and Claude's model? And so the answer to your question is, if Google or Anthropic were to terminate their data center leases, that would cause us to likely change our view in the greater context of a lot of other variables related to the valuations.
Louis, always so good to see you and to have you on the show. Enjoy the weekend.
Fantastic. You too.
And we showed you earlier Yahoo Finance's AlphaSpace platform. It's a new professional-grade financial platform featuring advanced charts, real-time news, customizable investment research, and more. You can access all of those tools by going to our website using alphaspace.finance.yahoo.com. Well, Netflix shares tanking today. That's after the company's third quarter outlook fell short of expectations and engagement trends failed to inspire confidence on the street. Yahoo Finance's Julie Hyman spoke to Jessica Ehrlich from BofA Securities about that report.
We could look and go through the numbers, et cetera, but I'm curious about your big picture view about what Netflix needs to do here to right the ship, whether it's fundamentally or in terms of investor perception.
At the moment, it's in no man's land. The quarter was okay, as you said. It wasn't a big beat or a big loss. It wasn't anything surprising either way. But there's just not enough here to move the stock in any direction. So there wasn't enough for the bulls, and there certainly was something for the bears, but not. I guess there was something for the bears because the company. There's just an overhang. The numbers are fine. The platform is growing, meaning we're looking for double-digit growth, improving margins. You see advertising growing pretty rapidly, but there's an overhang. Will they make an acquisition? The company is now down 50% from the high, and it's trading below the S&P 500. It's probably the lowest multiple Netflix has ever been. It's trading at like under 17 times EV to EBITDA on 27 estimates. So there just wasn't like anything to really hang your hat on as you look forward. But again, if you step back, it's not like there's anything structurally broken.
Right. And it doesn't seem like it was terrible, but it just wasn't good enough to get people excited here. You mentioned them having sold off after not going through or failing to get the deal done with Warner Brothers. Do they need to make an acquisition now?
Need and want are always two different things. Do they need an acquisition? I would say probably not. But should they make an acquisition? Probably yes. We'll see what becomes available. They did not. They walked away. They were very. I think they were. They were pretty strong and disciplined when it came to Warner Brothers Discovery. They clearly were not, for whatever reason, price, political, whatever. We're not going to get that. Will NBCU become available? Maybe. The company Comcast announced that it's splitting into two. So one side will be the cable with platform business, and The other side will be NBCU. Universal has a fantastic film and television library. They also have really strong theme parks. And over the last couple of years, Netflix has gotten into the experiential and live business. So it's something that would fit and would probably, help them with growth given the IP that's involved.
What you were talking about sort of speaks to the next thing I was going to ask you about, which do you think it is more of a priority for Netflix to build up library and catalog or to come out with better new content? I mean, anecdotally, this is a very small sample size, but like talking in our show meeting this morning, talking with a couple of guests we had earlier on the show, this show that they touted, I Will Find You, like nobody had even heard of it who we were talking to, let alone had watched it. Which feels, I mean, again, small sample size, like white collar New York area people, but like that doesn't seem great.
No, everybody I spoke to said the same thing.
Yeah.
Absolutely. So there hasn't been a breakout hit like Bridgerton or Stranger Things or Squid Games for a while. But it's easier said than done. This is a very difficult business. And as great as Disney has been, or any of the companies, the media companies have been, you really can't just create a hit. It's just not that easy. So that's, maybe part of the issue. Part of the issue, maybe that they're pulling their engagement, they're releasing their engagement data from twice a year to once a year. And when there's less information rather than more, it's always, a concerning sign. But look, it's a giant platform with over 300 million subscribers, almost 1 billion viewers. And their engagement is probably 2 hours a day. How much more? When you're that big, of course, the engagement will not grow as fast as it did when they were smaller. Having said all of that, could they use an acquisition and have more IP? Of course. I think that would be super helpful for their business model in the long term. It's not a library that's really been picked over, and it's very high quality. I'm referring to NBC Universal at this point. But if they don't have it, they still will, be able to create programming globally, both television, film, and they're also expanding the kinds of programming that they're providing, whether it's sports or live, non-scripted, video podcasting. They're doing, experimenting with short form video content. Video podcasts. So there's more content and more kinds of content on the platform.
Jessica, if not Netflix right now, what do you think is the best streamer right now from a stock perspective that investors should own?
Well, unquestionably, it would be Spotify. It's a streaming platform, but it's not probably what you were asking, meaning, it's not the video platform. And, look, we don't cover Amazon and Apple, and nobody would buy them for the streaming platform. And I probably say the same thing for most of the other companies. But on Spotify, this is a growing global platform with audio and video products, and they have tons of add-on products over the next few years. Whether they move from podcasting to video podcasting, audiobooks, they'll have a more premium audiobook service. They're coming out with some AI driven products for customers. But they also showed us at their analyst day in May other things that they're coming out with. It's pretty clear that this is a company that will leverage the platform that's in place. They're growing subs, they're growing pricing, they're growing advertising, and with more products, they can actually charge differently.
I mean, it's interesting because both Spotify and Netflix are down about the same amount over the past year. But to your point,
Very
Spotify
similar.
does seem to have more of these catalysts. What do you think so it sounds like you think Spotify, at least in the near term, has more room for upside than Netflix. But what's going to get investors on board for that one?
As they roll out products. So they do have a pretty robust product pipeline coming. They never tell you exactly when they're coming. But again, they showed us so many of the things that they've been working on and will roll out in the next year or so. And so there's a little bit more visibility, more catalysts with Spotify. But you're 100% correct that both Spotify and Netflix seem to perform, maybe not exactly in tandem, but they're very similar patterns. But whether Spotify can break away from that, given what looks like a very strong, really strong set of products coming, really good growth, maybe faster growth than Netflix, they should be rewarded in the stock. But look, we have a buy on both companies, and both companies continue to grow.
Coming up, a venture capitalist breaks down the new IPO market playbook. That's next on Market Domination. Venture capital is still flowing, but our next guest says investors are becoming more selective as companies stay private longer, and the bar for an IPO keeps rising. Joining me now on this, we've got Aman Verjee, general partner at Practical Venture Capital. Aman, it is good to see you. Maybe start here, Aman. You say that venture capital is broadening, not away from AI, you say, so much as branching within AI. Explain that for us, Aman. What do you mean there? And where do you see the strongest AI opportunities right now? What excites you? Which sectors, verticals, subsectors?
Yeah, great to talk to you, Josh. We've been following the AI impact on VC for a while. The first thing I want to say about the AI impact on the category is that it's bringing in a lot of new investors, a lot of new business. I think this year is going to be a record for the category. Like the first half of the year saw about $500 billion in money raised. That's more than the entirety of 2025. But what's really driving it is a handful of very large companies, OpenAI and Anthropic, and you get Waymo and you get xAI, and they're accounted for something like half of the overall money going into the space. So there are a lot of very successful companies that are growing revenues at a rate that we've never really seen before. Drawing in a lot of capital from a lot of new investors, and we'll see a lot of funds returning capital because it'll be a record IPO proceeds year as well. So a lot of funds will have DPI, and that's going to help with fundraising. But it's also getting very concentrated into a handful of companies that are getting very heavily bid up. So what we're really looking for is AI-enabled companies, founders who understand how that technology enhances their business and how to accelerate growth and the satisfaction of their customers, and use that technology to then build a more successful franchise. We're a secondary fund, so we're looking at buying out existing investors from companies and giving them liquidity, and that's a whole new category and a whole new space in VC that's exploding as well.
It sounds like, Aman, you're more bullish on Anthropic's IPO prospects than OpenAI's. How come?
Well, I think a couple of reasons. Definitely, I think Anthropic has got the lead right now in terms of their customer traction and their revenue growth. The last time they gave us a number, just in terms of their revenue, they're at something like $60 billion in ARR. The last number that we heard from them was 47, but if you extrapolate the last couple of months out in the growth, they're probably close to 60 billion in ARR. They're growing at about 10x year over year, which is, I don't think we've ever seen anything like it in any kind of public company, private company, or anything else, not only the US, but anywhere in the world. And so, and I think what we'll see in Q2 as well is that they may be profitable, which is not something that we would have expected at the start of the year. So I like the fact they've got top line momentum. They've got the ability to generate profits in the business if they want to. OpenAI is I think that's a very difficult IPO. I mean, the financials aren't quite as far along as Anthropic, for one. For another, their ability to generate profits and just the fact that pulling in a lot of money is a negative, especially in this market. The other thing I'll tell you is I've been on public company teams before as a CFO, and when the team is not together and hasn't gelled and hasn't spent time together, it is really hard to get a company public. And the list of people on the OpenAI management team who have left or come back in the past 12 months includes not only Sam, who's the CEO, but founders like Ilya Sutskever and John Schulman. Jan Leakey was the super lineman co-lead. He left. Brad Lightcap was the COO. He's on special projects. I'm not sure I know what that means, but that's not good. Murad Muradi, Andre Karpathy. They've had a couple of board members leave and all kinds of just anxiety. Fiji Simo, who I used to work with at eBay, is on leave. Kate Roush, who's their CMO, she's on leave. So just a whole raft of changes on that management team. That, as a public company investor, doesn't make me feel great about the prospects for that IPO.
Finally, Aman, I want to get your take on SpaceX because you're an investor there as well. Punch through its IPO price. What's happening there, Aman? And what are some potential lessons learned?
Well, I think the IPO was actually really well executed. They the thing that they did, which was unusual, is that they didn't really do price discovery on the roadshow, and they didn't have a range, right? They priced 135 per share. They first stick to 150. It popped up to about 200 and is now, I think, just broken issue and come back below. There's just a lot of volatility in that stock, but that is something that we kind of expected. If you rewind to the beginning of the year, their valuation before they bought XAI was $1 trillion. Actually, the last round they did was $800 billion, and then they priced their IPO at 1.75, and now they're about 1.6. And so if you look at the last year or so, I think it's been good progress overall in the valuation. I think what happened was there was a lot of excitement when they priced the IPO, and that's what caused it to go up. The market in general has been a little soft, and so it's traded down. But we've seen all kinds of great companies historically go below the IPO price, in fact, draw down by 30, 40, 50%. Historically, we've seen, I remember when Facebook went public in 2012, they priced at $38 a share, at one point dropped to $18 a share. There were a lot of sellers. Anytime something goes below the issue price, there are sellers. And at that point, it was like a $45 billion market cap company, and now it's $1.5 trillion. And it's not just Facebook, but Palantir and Airbnb and Snowflake and Datadog and Uber. All kinds of great companies have drawn down post IPO just based on volatility and how the market trades, but have done well. So I think what we're seeing is just volatility inside of that lockup period. They've signed a couple of great deals with partners to generate AI-based revenues, so they continue to generate progress in terms of the business. We'll see how the earnings go in a couple of weeks. But the fact they've gone below the issue price is just a negative signal. And as you know, there are a bunch of investors who just sell when that happens. And right now we're thinking of it more of a long-term play. So I'm not sweating the day-to-day moves in the stock price too much.
Aman, great to have you on the show today. Appreciate your time. Thank you.
Thank you.
Stocks ending the day lower here. I find says Jared Blickery standing by with all the latest. Jared.
Yes, kind of a negative day on Wall Street for the week as well. Let's check out what the Dow Jones doing. Dropped 400 points today, 0.75%. And we'll check out the 5-day total. And you can see almost down about 1%. Not a disaster, but the Nasdaq saw a lot more volatility this week, down about 3%, down about half of that today. S&P 500 down about 1.5%. And got to show you what's going on with the semiconductors. The SOX is now in bear market territory, quite below. I think it had to close at 11,707 or lower, and that is quite a bit lower than that. So Semiconductors in the U.S. have entered a bear market after memory stocks, I'm kind of using DRAM as a proxy there, fell into a bear market a few weeks ago. Nevertheless, software did not do that badly this week, and you can see a small gain there, up about 0.5%. Now let's get into some heat maps and see how the large cap sectors are doing, and I'll show you there. Only energy in the green today, kind of ominous. You don't want to see most of the sectors in the red on a Friday, but I'll show you what they did for the week. We did see some rotation, and there is some green here. Energy, real estate, staples, financials, and healthcare in the green. All of those except financials, and that's because of big bank earnings there. But those other four sectors, a bit defensive, so the tape is starting to look a little bit negative. And you can see XLK, that's tech, down 5.5%. The only underperformer from the S&P 500 is consumer discretionary, down about 1.5%. So let's take it to the Nasdaq 100. This is what happened today. Pretty red tape. You're going to see SpaceX down 5%, well below its IPO price of $135, well below its first print of $150. That is $123.99. Ouch. And I'll show you the 5-day view on the Nasdaq too, because mega caps were not a total wipeout. We did see some positive gains and some record highs from Apple up 6%, Microsoft up 2%. But look at all this dark red on the board. A lot of that is centered in semiconductors, and that goes back to that them going into a bear market, which we were just talking about a minute ago. If I sort by performance, you're going to see, and this is only 1 week, on the bottom line, we've got DRAM down 16%. That's that memory trade ETF. Global Foundries down 16%. SanDisk down 30%. A lot of damage was done here. If I show you what happened in software, we get a bit more green. In fact, a pretty good picture there. Besides Oracle down 10% and Cisco 7%. IBM 26%, but the green here vastly outnumbers the red. If I sort by performance, you can see probably 3 or 4 to 1 right there in a ratio. The Dow this week, not too bad. We did see industrials fall off a little bit. Caterpillar down 7%. Cisco, I just mentioned, down 7%. But here's Chevron up 6%. Healthcare did pretty well. Mark up 3%. And some of those defensive trades like telecom, Verizon up 3.5%. I do want to show you, here we go. Let's go to crypto because we had some interesting things happen in crypto. You can see over these 5 days, I should probably do 7 there, but this is since Sunday night. We do see Bitcoin trading at around 64,000 and basically break even over these last 5 days. And then we have Ethereum up 3.7%. and Ripple up 2%. Finally, I will leave you on China. It was not a washout for China either. We did see this some gains there, and these are kind of uncorrelated returns to what we find in the US, so something to think about as we enter earnings season with all these ominous signs building. But as I said at the top, we're only seeing modest index losses for now.
All right, thank you, Jared. Coming up, we speak to a strategist about the latest market action. That's next on Market Domination Overtime. For a closer look at today's market action, we have Brad Long, WealthSpire's Chief Investment Officer. Brad, it is great to see you. I actually wanted to start, Brad, get your thoughts on the chips. My colleague Jared Blicker was just talking about that. Big story in the market. This group enjoyed a tremendous move, and for good reason. You had these chip CEOs and CFOs, Brad. They came on and said, listen, business is strong, fundamentals are strong. They talked about how demand just keeps outstripping supply. But now we have sold off. As Jared mentions, the SOX is in bear market territory. And I'm just curious what you make of that, Brad. Do you see that as just, listen, we're letting off some steam after parabolic moves, or no, did something more fundamental and structural shift here, Brad?
Yeah, I would maybe call it more of a summer blow-off than a structural shift, right? Anytime, before you go month to date, right, we've had a really great run in chips, ton of AI investment. Obviously, it's flowing through to earnings. Q1 is pretty extraordinary. Software was one bookend, chips was the other. Here we come. We've got Moonshot hitting us this week. We've got, semis really priced for, if not perfection, at the very least performance. And, we're at the front end of earnings season. So TSMC and others showing a little bit of shakiness on, where chips could go from here. So I wouldn't call it a fundamental shift as much as I would call it, maybe people are going to the beach, a breath of fresh air in the middle of summer, or maybe not the right phrase given the fact that the Northeast and at least Chicago have a lot of smoke in the air. So not fresh air, but a big breath or step back.
And I guess for the broader market, Brad, are you confident that, okay, if chips are going to sell off, if you're going to let off some steam here, can they hand the baton off? All right, Mag 7 and the financials pick up the slack and we can keep moving higher?
If we're able to achieve anything near expectations for Q2 earnings, absolutely. If we look at Q2 expectations, about 23% for the quarter, and obviously we've just begun this week, great start from financials. But if you put Q1 and Q2 back to back, right, it would be the only time we've achieved 20% or more earnings back to back outside of the bottom of recession. It was the bottom of '02, it was the bottom of '09. It was COVID, in which you had these base effects and you had earnings rising in a material way. So if we can even sniff 23, yes, the baton can be carried elsewhere. Now, I will say that's a very high bar. If we can't meet that level and we're still in the double digits, that's still great company to be in. 7 straight quarters of double-digit earnings growth, mid-cycle. That's a great spot to be.
We're heading right into the teeth now of earnings season, Brad. Those Mag 7 names are on deck. What are your thoughts, generally, Brad, there? You think you're going to see big tech beat and raise? And importantly, Brad, do you think they're going to say, hey, yes, CapEx spending, that is going to keep moving higher this year and next?
CapEx is going to be the interesting discussion. I would say just based on momentum, we'll probably see a lot of beats. We may see some raises, but the direction of CapEx and cash flow are going to be really important. Where markets are priced today, again, they are priced for performance. So S&P 23 times forward or 15 times cash flow. If we're not just taking CapEx and actually working it through the income statement into earnings and cash flow, markets are going to rightfully take a step back. So that will be the interesting important as we come into, as you say, the teeth of earnings season here. And we'll look to see if we'll be able to really convert, because the AI CapEx cycle has got us to where we are now. It's built expectations to where they are now, but now it's really time to perform.
How confident are you, Brad, as an investor and a strategist, that this historic big tech spending we're seeing, you're talking about companies spending hundreds of billions of dollars building out their AI dreams. How confident are you, Brad, and how confident should we all be that you're going to see a really healthy ROI ultimately on all that spend?
It's quite literally the multi-trillion-dollar question. It's pretty clear that AI is here to stay in a material way across a lot of sectors and a lot of roles where you're going to have tasks that were once low value add tasks, and you're going to get a better ROI per employee and add to the margin of businesses. Is it going to be at the rate that we'll see and that's required at the CapEx levels today? That's a really hard one to answer. Over time, what we typically see is as you see lots of opportunity, lots of money flowing into these spaces, it draws competition. We saw it from Moonshot this week. It's really going to go from, I would say, what is kind of the rideshare model, right? AI, it was not a marketplace that existed like rideshare many years ago. So you had Uber largely out there trying to invent the category and giving you a ride for a pretty low rate. We're actually now shifting into the true economics, right? If you look at token costs, if you look at co-work across companies, all the prices are rising pretty materially. And now we're actually getting from revenue growth to earnings growth. So the ROI will be there, but now we're really getting to the meat of what is it going to actually cost to use AI? What is the ROI per employee? And what's the productivity ultimately on a company balance sheet? So it's here to stay. Is it going to justify trillions in spend? I don't know. That's a big question.
Brad, switching gears, I want to talk about another big topic in the market. That's oil prices, U.S.-Iran escalation. I see a WTI back at 82 and change here. How are you thinking through that as an investor? What do you tell clients? What does it possibly mean for the trajectory of inflation?
Markets have been extraordinarily focused on fundamentals as of late. So we just talked through earnings season, and that's been the hook they're hanging their hat on. If you think back to February 28th and we engaged in military conflict in Iran, markets sold off very heavily in March. Here we have an MOU that's largely fallen apart. You have not just escalating rhetoric, but escalating action, and oil's moving back up the curve. That will and does have a pretty material impact on the real economy, right? Energy flows through to everything, including chips and including AI, as we were talking about, or helium moving through the strait or moving to the east, like China and Japan. Those are important things in the production of chips and memory and compute and power, right? Energy is a big part of power. So this is going to be one of the key things we need to watch. Ultimately, nations around the world have mitigated this risk through drawing from strategic reserves. Investors have been, I would say, fairly blasé about the idea that the strait will shut again and the risks that it accounts for. And obviously, the Fed has been keeping a close watch. We saw minutes last week. There's a pretty diverging or polar view on what the forward look on inflation will be. So this is one of the key macro things we're going to have to watch over the coming weeks.
Brad, as always, great to see you. Thank you.
Thanks for having me.
Coming up, Gen Z, more concerned with saving for vacation than retirement, according to a recent survey. We're going to dive into that next on Market Domination Overtime. Nearly half of Gen Z workers say saving for a vacation takes priority over retirement as higher costs weigh on long-term savings. For more, we're bringing in now Yahoo Finance senior columnist Carrie Hannon. All right, Carrie, let's just dig right into this headline here. Why are so many Gen Zers prioritizing vacations over retirement savings? What do we make of that, Carrie?
Well, I love it, Josh. Do you remember being in your 20s? I mean, retirement seems like such a distant concept. You can't even get your head around it, right? It's so far down the road. And so, they're saying, I'd rather save for a vacation right now than save for something decades down the road. They're also saving for to pay off student debt, which is a very good thing as well. But I mean, I think this is probably, it's a big figure, saying nearly half say they would rather, they prioritize saving for vacation over retirement. But I think it's part of being in your 20s.
So I was going to ask you, Carrie, whether you thought this trend, is this Gen Z specific or no? Is this a dynamic you see playing out across, multiple generations?
Yeah, Josh, it is a bit broader, but I will say I feel the reason why Gen Z, why it's a concern, is they really are missing out on that compounding of investing for the long term. It's that decades down the road. So that's the big concern there. But we do see in the study that I looked at this week from JP Morgan Asset Management, they showed that, yes, it's a kind of across the board, not quite as high, but 3 in 10 of older workers or workers over, 30 plus, they too say that, they would prioritize vacation, and they would prioritize also paying off education loans, and importantly, paying off credit card debt, which in many ways is a good thing, but not quite at the levels that we saw with the Gen Zers. And they also, almost across the board, everyone said, you know what, I know I'm not saving enough for retirement, and I know it, I'm not, and I'm going to try to do something about it.
The report suggests, Carrie, do I have this right, saving 12 to 15% of income for retirement? I mean, for a viewer watching this, Carrie, maybe they're nowhere, near that bogey. What would be your advice?
Yeah, Josh, that's a sweet spot. And that's a combination of what you set aside in your 401k from your income that goes directly to your 401k and what your employer matches. So employers typically match between 4% is usually an average amount there. And some really generous ones go up to almost 7% of your salary. So if you put aside, 4%, they will match another 4%. Now that's really sweet. That gets you up to 8%, right? Now, it is definitely something to aim for. When you're young and you don't have that much to set aside, the best thing to do is just get as close as you can to, so you get the full match that your employer is going to put in, that 4%. And then pay attention to auto escalation. Most employers now will automatically up your contribution each year by, a percentage or so. So go with that, let it ride and watch it. And if you can, make it a bit higher, but you can do it in increments if you've got some time.
Carrie, always great to see you. Enjoy the weekend.
You too.
We're shifting gears now. Yahoo Finance senior autos reporter, Pras Subramanian, joining me now with a demo of the Mercedes-Benz CLA 250. All right, Pras, what do we need to know? Bring us up to speed.
I first got to say I'm wearing my Spain jersey. So
yeah,
I
did notice that.
I don't want to look out of place here with the German car. But yeah, Mercedes has had EVs for a while, and they had sort of controversial styling, very swoopy and blob-like. But now Mercedes sort of rejiggered that, and when the new CLA 250 Plus EV is their latest attempt to correct some of these design issues, and it has a more of a attractive car, a sort of Model 3 kind of footprint, a smaller sedan, and I think it's quite nice. I think they did a great job with on the outside here. I think it did a phenomenal job with lighting and sort of the profile here, not too like blob-like, right? A bit more aggressive. Interior-wise, also very nice in there, very Mercedes elevated experience. And this is also, Josh, this is the base car, right? So this car starts at $45,000. So I think that's a pretty good value. And for people like you, Josh, it's going to be a gas-powered hybrid as well.
Oh, that's what we like to hear.
Yeah.
Let me ask you this: you didn't just report on this car. You drove it. How did it feel? Were you impressed?
I had to drive it. I had to do it. So Mercedes has it in as their test fleet, and I was able to get it for a weekend. And it's the CLA 250 Plus is just the rear wheel drive car. Excuse me. So excuse me there. So basically, 250 horsepower, doesn't sound like much, but it's all, the torque is right off the top here. It's very quick, very darty, very maneuverable, not too heavy for an EV. I thought it actually performed really well, and it was actually, again, like I said, a nice place to be, so very comfortable. It drove a nice pep to it. Now, you're not gonna go past 80 miles an hour here. It's not that powerful of a car. I mean, you can, but it's gonna sort of top out at that kind of speed. But for anyone who's living in the city, suburbs, et cetera, a great commuter car. And the way I see it is it's a luxury alternative, right, to, like, let's say a Model 3.
Well, I was going to ask you, with this new car, who are they taking on here? Who's the competition?
It's not that much there in the sedan space, EV sedan space, especially at that price. You're talking about, like I said, the Tesla Model 3, maybe a Hyundai Ioniq 5, but that's more of a hatchback. It's really aimed at, I think, the Tesla Model 3. And the Model 3 is a great car. It's a fantastic car. But it's not exactly a luxury car, right? It's a premium. It's very comfortable. But, you know, at $45,000, the Tesla version of that car, a rear-wheel drive Model 3, is at $38,000. So you're comparable there, right? A little comparable there. Now, the car I had, of course, was optioned up to about $65,000. So that's a bit much. The Tesla premium all-wheel drive is around $47,000. So there's a big difference there. But you're getting a lot. I mean, you had 3 different screens in the front. You had a lot of different options, a lot of different comfort features that you don't have in the Tesla versus the Mercedes. So I think it's a different type of buyer. But at the same time, if you want to go $45,000, you could do that, and you could go in a Mercedes. So I think it's a great value proposition. Also, want to know 380 miles in that base version. So that's a lot there. A lot of money, a lot of EV there for the car if you're into that kind of thing.
Prosper Moranian, thank you, buddy. Plus, another launch to highlight here at Yahoo Finance. There's a new hub to check out on the website dedicated to autos and EVs. We're bringing you expert coverage from Yahoo Finance and other leading publishers. To find out more about Yahoo Finance's Autos Hub, click the QR code on your screen. Coming up, the super rich are land maxing and buying up entire blocks. We'll dive into that next on Asking for a Trade. Hello and welcome to Asking for a Trend. Well, forget buying the biggest mansion on the block. The super rich are land maxing, snapping up multiple properties to create sprawling private compounds. Joining me now is someone who's seeing this trend in real time down in Florida, Danny Hertzberg, co-founding member of the Jill's Zeter Group. Danny, it is good to see you. Maybe start at a high level, Danny, because we hear about this term maxing. What do we mean by land maxing, Danny? Explain that to us. And how long has this been a trend for your clients there in Florida?
So this was a long-term trend in Florida, but it really took off after the pandemic. As we had ultra high net worth billionaires moving from New York and California and Chicago, the idea of acquiring the neighboring adjacent properties and creating an assemblage that goes above and beyond the value of the multiple properties has been a really big trend, and now coined with the name land maxing.
Can you give us some examples, Danny? Like, who's actually doing this? Who's building compounds in your state of Florida?
So I'm careful with names because we work with a lot of high profile individuals, but let's say the biggest names in tech and finance, many of these sales record numbers in the city of Miami and across the country. We're seeing this trend in Miami, in Aspen, in Palm Beach, in some of the most sought after markets. And we're talking the principal residence is acquired. And then the idea of acquiring the neighboring residences on the waterfront, maybe even the non-waterfront properties in front, to create paddle courts and secondary compounds and tennis courts. And it's the idea that your home is your castle. It's also a hedge against inflation. It's for privacy reasons, many different aspects where people don't just want the home, they want the entire block.
Yeah, I think did you tell the Journal, do I have this right, Danny, that a compound can now be more sought after actually than a 40,000 foot mansion? I guess why, Danny? Like, what's the difference?
Sure. So there was an idea, let's say if we go back 10 years ago, where people wanted enormous homes, 20, 30, 40,000 square foot homes with bowling alleys and 30 bedrooms. That idea has become a bit passé. Now people want to have, there's a wellness trend with the paddle courts and tennis courts and a main pool and a lap pool. The idea of having secondary residences and guest houses and staff houses and having more land. It's not about the interior square footage. It's about the land. And land brings extra land, creates privacy. It allows you to have an enormous boat that doesn't block your view. There's a lot of good aspects. I think also people are defensive buying in that rather than having one of your neighbors build a new home and live through 5 years of construction, many of our ultra high net worth clients, they want to buy the neighbors before they sell to somebody who's going to build, and then they control around them. And it's a real defensive buying position. But people are realizing that the cost of acquiring the neighbors, in many cases, in the most sought after areas, the property is now worth more than the two properties combined because of the scarcity of being able to assemble these ultra large properties.
How much of a premium, Danny, will a buyer pay for an adjacent property if that property they know would expand or complete the compound?
I'll give you an example. One of the highest per foot land sales in Miami was $1,500, $1,600, $1,700 a foot. We recently saw an assemblage play that was well over $2,000 a foot to buy the neighboring property, probably 2x on the market. So anywhere from 30, 40% premium to, in some rare cases, 100% premium.
Is there ever pushback from neighbors, Danny, when this is going on? I mean, I would imagine not everybody wants to live next to a compound.
Yeah, we had an example that we were just showing the B-roll. At the time, it was the most expensive property sold in the history of Miami on Lagos Island. And the individual who now passed, the proceeds went to charity, but acquired the adjacent neighbor, then the adjacent neighbor after that, and the adjacent neighbor after that, actually acquired 5 properties where they had a large portion of the island. And you have mixed reaction from neighbors. Some neighbors feel like we'd rather have one owner own 5 properties rather than have 5 different families with more traffic and landscaping and pool service. But others feel like their concerns are that with that much land, it could result in having a giant property that could, tower over the adjacent homes. But in reality, most of the assemblage plays and the land maxing has not been to build larger residences. It's to really have land around your residences and all the, incredible offerings that is for gardens and courts and all the different aspects.
Before I let you go, Danny, just a more general question for you. I'm just curious, how does the the broader luxury real estate market look like right now in Florida, Danny, versus, I know 6 months ago or 12 months ago? Would you say it's the same, better, worse? What are the trends you see?
So it's quite remarkable, but the Florida market is continuing to grow, particularly the prime areas of Miami, Miami Beach, Coral Gables. The all-time record, we just sold the most expensive home in the history of Miami this year for $170 million. So the per-foot records are being broken. The total sales price are being broken. The market continues to grow because people are moving from all over the country. We have no state income tax, very pro-business, very safe environment. We also have great weather. And so the market continues to grow at the highest end in the Miami market.
Danny, great to have you on the show today. Thanks for your time.
Thanks for the opportunity. This was great. Have a good one.
You
Take
too.
care.
Coming up, how to know if an expensive vacation is actually worth it. That's next on Ask You for a Trend. Summer travel is in full swing, but for those on a budget, how do you know if an expensive vacation is actually going to be worth it? Joining me now, we got Amanda Frazier, Forbes Travel Guide President of Ratings. Amanda, it's good to see you here. You say that travelers should start with the purpose of the trip, not the hotel. Explain that, Amanda. Like, what are the questions people should be asking themselves before they even book a trip?
Good afternoon, Josh. Nice to see you again. I think at the end of the day, the biggest thing is that, in travel, the prices are rising and people aren't really concerned so much about how much the hotel is. What they're really concerned about is, was it worth it? And at Forbes Travel Guide, this is something that we're looking at every single day. So yes, the price obviously is something that people are sensitive about, but the segment that we're looking at, was it worth it, is the biggest question.
A lot of folks probably do equate price with luxury. In your experience, can a hotel be expensive but still fall short?
A hotel can be expensive and fall short because at the end of the day, what everyone's looking for is the output of service. So that price is not necessarily a guarantee of the experience. So that's why we're in there day in, day out, looking at this and making sure that especially the hotels that are on our list are delivering at that level. I think guests are looking for a more emotional connection with their travel and a really authentic connection. And that's really got to come through to make them feel that sense of value.
Social media is interesting here because it can be filled with all this content. They look at incredible hotels, influencer content. How do travelers, in your experience, how do they smartly sort of differentiate, social media and marketing and hype and fluff from reality?
There's definitely a clutter of online information, but there's definitely room around the table for a lot of different opinions. I think at the end of the day, what you really need to be looking for is a trusted voice. Obviously a trusted rating system like Forbes Travel Guide, or certainly a trusted travel advisor. The authenticity that somebody that's actually been there and can give you real-time advice based on, their current experience.
Do you think, Amanda, social media has influenced and impacted traveler expectations, like what people are looking for from a hotel?
It definitely has, and I think when you are you're aspiring to travel and you're thinking about where it is you want to go and the type of experience that you want, that's really, really helpful. And that's absolutely where you should start. But then to know how to ensure that you're getting that authentic experience, you really want to put your trust in a system or a individual that's been and that can actually give you that up-to-date information.
What do travelers want in a hotel, Amanda? I'm curious how that has changed, how that has evolved. Do they want, is it bigger rooms, better food? Is it, wellness experiences?
It's all of that. It's all of that. But, at the end of the day, really for us especially, and for the travelers, it comes down to two things. It's authenticity and it's consistency. And when we say authenticity, this is more than, if you're a hotel in Mexico putting some Mexican pottery in your room. That's not what we mean by authentic. We're really talking about the culture that you're building and the staff that you're hiring. And then consistency is not homogenizing the industry. We don't mean everything has to be cookie cutter, but really at the end of the day, consistency really gives that guest the impression of confidence. And when that guest is confident in the service levels, which is the key here, then you win their business back. And that for hotels is the biggest reward.
Are there new luxury trends, Amanda, that you see gaining momentum right now that might surprise viewers?
I think, and you talked about this in the last segment, well-being is huge. And the investment in not only your own well-being, but your family's well-being and considering that around how you travel and the places you go and the hotels you choose to stay. That is a huge focus and a hyper focus, actually, and we expect to continue to see that rise.
Let's end here on some examples. Amanda, I'm just curious, are there some great hotels out there that you would emphasize that maybe the average traveler might not know about, but that in your opinion, listen, they get it right. They really elevate the experience?
There's a lot to choose from. We actually just published a great story about, you're talking about summer travel. If you're traveling with your family and you're really looking to involve them in the overall experience, you've got the Joali Being Resort in the Maldives, which have a fabulous program that's centered around family activities, and they can really make sure that everybody not only bonds, but has something really centric to what they're looking for. And of course, it's focused around longevity and well-being and teaching that at a young age as well.
Amanda, great to have you on the show. Thank you.
Thank you for having me.
Warren Buffett has criticized present-day markets, saying it's hard to find value when everyone is gambling. Yahoo Finance's Julie Hyman spoke to Tyrone Ross Jr., CEO of 401 Financial, about the keys to unlocking value in today's markets.
When Warren Buffett talks, we tend to listen. And, he has been on right. I mean, he gave an interview this week in which he reiterated these comments, but he's talked a lot in recent years about what he calls the casino-like atmosphere that he thinks has come to equity markets. I mean, you deal with a lot of, younger clients. How do they feel about value investing? Do they see it as something that is sort of outdated?
They do. I think value investing is something that needs more education. I think there are a lot of young investors that have a lot more options that older investors didn't have, and it's chasing the next shiny object, unfortunately. And if every firm has a brokerage now, they're rolling out some type of prediction market or some type of, perpetual DEX to trade and futures. And it's insane. So, yeah, I think value investing still has a place, but I think it's incumbent upon fiduciaries to educate a new generation on what that means to find value and have some patience and hold long term.
I mean, and Buffett has also said, it's tough for him to find value in the market. I mean, certainly we've seen that because Berkshire Hathaway has not been deploying as much capital in recent years. So how do you look for it? How do you advise clients to look for it?
What we've done actually is started to, again, educate clients on what value investing is. I think 12% over the last 5 years or so. So definitely not going to excite grandma at Thanksgiving. But I think we've also started to look overseas, expose clients to VT, which is a mix of all the companies here and globally, to kind of start to show them investing beyond our shores and try to find value outside of U.S. markets, which we feel is fairly value right now, pretty rich, if you will. But that's really it. It's more of an education. It's a conversation and not what is the next thing that's going to go up 100% in the next 6 months.
Right. And on the flip side of that, you have the casino-like atmosphere in stocks, and then you have actual casino when you're talking about prediction markets, right? And something I was thinking about this morning, Tyrone, it was so interesting when crypto got to the acceptance level enough that you had folks like you coming in from the advisory side saying you want to allocate X% of your portfolio to this. Are we at a point where you would do that for prediction markets? Do your clients come, because you want to limit the risk, right? So is that a conversation that you're having at all?
It's not a conversation that we are having, and I don't think it's a conversation financial advisors should be having right now. Obviously, listen, what clients want to do away from the advisor, they should let their advisor know. But I think it's also prudent upon financial advisors to say what is the right thing to do in the scope of a client's long-term goals and just what's just pure gambling. And I don't think any advisor, any fiduciary for that matter, wants anything to do with gambling. So yeah, I think it's tricky here. We don't discuss it. We haven't had the opportunity to, and if we did, I would express the sentiments that I just shared with you.
Gotcha. No allocation towards gambling. That makes sense. That said, I think Buffett too has talked about crypto as gambling, right? And so as somebody who is steeped in the crypto world, how do you think about that?
Well, this is the part where the audience goes, hypocrite. Now he's about to So it's very similar in this regard. If you are a short-term trader and you are trading crypto, to me, yes, that is gambling. Long-term investing on any asset class to me has a plan. There is a process of when to get in and get out, and crypto as a new and novel asset class falls into that bucket. Now, folks would still argue, well, it's new and novel. There's not a lot of track record. There is gambling. Yeah, but I could say the same thing in equities as well. So I think long-term, being, very constructive on your views of why you're investing, when you're going to get out, making sure your financial plan is in place. I think crypto has its place as a long-term investment. But anything that you're going to trade with the hopes of getting rich quick will be and should be considered gambling.
And finally, I want to ask you about how you're thinking about Bitcoin prices right now, because we've seen them kind of bump along the bottom here. What are you hearing from clients? Are they sort of true believers, or at least patient enough that they're going to hang on through this?
Yeah, so again, our clients like us tend to be crypto hippies. They're true believers. They're not going to leave. I personally believe that we go lower and a lot lower. I don't know when, and I don't know what that catalyst would be. It could be the Clarity Act not getting passed. I don't know, but I do think we're not out of the woods yet. And I think that's a good thing for the space long term. I think so long as Bitcoin kind of hangs out above $60,000, that's not good long term. I'd love to see us go scrape the bottom at 35, 40,000, wash out all of the excess and crap that doesn't belong. And then I think we can start to push higher when you start to see all of the major announcements and things that are happening now. Those announcements usually happen right at the, in a bull market, if you will, that is really roaring. But to see some of these announcements in the bear market, you can see it's going to be the tide that turns the hand when we go higher. But yeah, we can and should go lower, and I think that'll be accretive for the space.
Are you and clients adding here, or are you waiting for that further drop?
We tell folks the dollar cost average, right? So they'll average in on the way down. But yeah, I think I mean personally, he needs to go lower. I'm backing up the truck. I might sell this couch you see behind me. But we do have clients actively and constructively getting in relation to what their other goals are. But yeah, this is with being down 50% or so off the highs, it is good to accumulate a position here and continue to dollar cost average in.
Tyrone, good to see you. Thanks so much.
Thank you for having me.
Stick around. More Ask for a Trend still to come. Time now for what to watch next week. Earnings season ramping up for big tech. Two of the Magnificent Seven are reporting after the closing bell Wednesday. Tesla and Alphabet. Tesla expected to post double-digit profit and revenue growth from the same time last year. And it comes after the EV maker topped estimates for second quarter deliveries. One analyst eyeing a few key issues on the earnings call, including the ramp-up of the Cybercab and the launch of the three-row Model Y. As for Alphabet, investors will get a clearer picture of how AI is changing the tech industry and whether these companies can live up to Wall Street's high expectations, especially after the warning from IBM. Investors will be keeping an eye on Alphabet's cloud and chips businesses, which could be another sign hyperscalers are taking away spend from other hardware companies. But if there's a sign of slowdown in CapEx, that could be a red flag for Wall Street. Other key results to watch next week: Intel, Texas Instruments, GM, American Express, and Verizon. It is a light week for economic data. We'll get weekly readings on initial jobless claims and mortgage rates on Thursday. And on Friday, we'll get new home sales for the month of June. That's a wrap on today's show. Thanks for watching.